The next set of consolidation journal entries that we will look at is the since acquisition consolidation journal entries. The purpose of these journal entries is to measure the NCI balance since acquisition date. The first journal relates to attributing the since to opening balance movement in the equity items of the subsidiary to the NCI opening balance. The only equity item in this example is retained earnings. To calculate this amount, we start with the trial balance retained earnings opening balance of the subsidiary of 42,500 Rand. That amount includes the at acquisition 7,500, which got eliminated at acquisition date. So the movement since acquisition date is the 35,000 Rand. Of that, 30% is attributable to NCI, giving me an amount of 10,500 Rand. To measure NCI opening balance, I need to remove a portion from the retained earnings opening balance of the subsidiary and attribute that to NCI. I achieve that with this first journal where I debit retained earnings opening balance of the subsidiary and I credit my non-controlling interest opening balance. What's important for purposes of Chapter 5 is to ask the question whether this opening retained earnings balance of the trial balance should not have been adjusted for the effect of the unrealized profit in opening inventories. We had a consolidation journal entry that said debit retained earnings opening balance. We saw that in Journal 3, retained earnings opening balance. But now it's important to realize that that was the retained earnings opening balance of the parent, the selling entity in this example, that was adjusted for the effect of the unrealized profit in opening inventories. Because B is the selling entity, NCI should not be affected with the effect of this consolidation journal entry. That is why the retained earnings from the trial balance of the subsidiary has not been adjusted with the effect of the 400. Journal 7 is the journal entry where a portion of the profit of the subsidiary for the current year is attributed to NCI. The journal entry is debit profit attributable to NCI, credit NCI. That amount is calculated as taking the profit from the trial balance of the subsidiary, then asking whether that amount should be adjusted for the effect of any consolidation journal entries, and if not, multiplying that by the 30%. In this example, the parent company was the selling entity, so it's the parent's profit that included the unrealized profit of 600 Rand at the end of the year. Journal 5, where we've eliminated the unrealized profit in closing inventories, the debit to cost of sales did change the group's profit, but it was specifically the parent's profit that formed part of the group's profit that was adjusted. The parent company was the selling entity. It's the parent's profit that had to be adjusted for purposes of the group profit. Therefore, NCI will not be affected with the 600 Rand. The first statement we will look at is the consolidated statement of financial position at 31st December 20x11 for the P Limited Group. The principle behind every single line item on your consolidated SFP is to add 100% of the parent's assets and liabilities to 100% of the subsidiary's assets and liabilities, because the parent controls the net assets of S. This combined total, line by line, should then be adjusted for the effect of any consolidation journal entries if and where necessary. The first line item is goodwill. There's no goodwill in the TB of P, and there's also no goodwill in the TB of S. So 100% P plus 100% S equals 0. But you've written the at acquisition consolidation journal entry to recognize the 5,000 goodwill. Inventories. 100% P plus 100% S. Those two amounts come from the respective trial balances given earlier in the question. That is always your starting point. 100% P plus 100% S. In the journal entries, the consolidation intra-group journals, journal 3 and 4, which we've looked at earlier, there was a credit entry of 400 to adjust the opening inventories to be in line with the closing inventories in the prior year. But because those inventories have been sold in 20X11, you had an immediate contra debit entry to inventories to cancel out the effect of the 400 Rand. It is assumed that inventories that has been on hand at the end of one financial year will, due to the nature thereof, be sold in the following financial year. If that is not the case, it has to be specifically stated. The 600 Rand gives effect to the journal that we've written for the unrealized profit in closing inventories. Included in the 15,000 Rand closing inventories of the subsidiary is inventories of 6,600 that was purchased from the parent, and that is overstated for group statement purposes. We wrote a journal under Journal 5 where we've credited the inventories of the subsidiary with 600 Rand. That is the effect of unrealized profit in closing inventories on the line item inventories in the SFP. The share capital is always only that of the parent because the share capital of the subsidiary gets eliminated through the at acquisition consolidation journal entry. For retained earnings, we will look at the statement of changes in equity. Some advice for answering a question. If you are asked to do the consolidated SFP, for retained earnings, it's always a good idea to follow the structure of a statement of changes in equity to get to your closing balance. Non-controlling interest is your closing balance for NCI, comprising your at acquisition measurement, your since to opening balance, and then your current year movements. The best way to calculate your non-controlling interest closing balance is on an analysis. We will look at that at a later stage.